What is growth investing? Growth investing is an investment strategy where you focus on companies expected to grow faster than the overall market. Instead of buying shares that look cheap today, growth investors look for businesses that are likely to earn more revenue and profits in the future. The idea is to invest early in companies with strong growth potential, no matter if their current stock price seems high. Growth investing often targets innovative or emerging industries such as technology, healthcare, or green energy, where expansion opportunities are significant. Why does it matter? Growth investing matters because it offers the potential for higher returns over time. By identifying companies with strong growth prospects, investors can benefit from rising share prices as the business expands. It also encourages a forward-looking mindset. Growth investors focus on the potential of tomorrow rather than the bargain prices of today. While this approach can offer exciting opportunities, it requires tolerance for volatility, since high-growth companies often experience bigger ups and downs in their stock prices. Growth companies also tend to reinvest most of their profits into expansion, which means dividends are usually smaller or non-existent. A long-term focus is key. Growth investing typically works best over several years, allowing time for the company's growth to translate into higher stock prices. Here's a simple example. Imagine a tech company currently earning £10 million in profits per year. A growth investor believes that, due to a new product, profits could double to £20 million over the next few years. Even if the stock price seems expensive today, the potential future growth may justify paying a higher price now. If the company meets or exceeds expectations, the share price could rise significantly, rewarding early investors. However, if growth slows or the company fails to deliver, the stock price could fall just as quickly. Many growth investors build a diversified portfolio of growth stocks to balance potential rewards and risks. What else should you know? Growth investing usually involves companies with high price-to-earnings ratios, meaning investors are paying a premium for expected future profits. Unlike value investing, which looks for bargains today, growth investing is more about the potential of tomorrow. This approach requires patience and a willingness to accept short-term volatility. Not all high-growth companies succeed, and investing too heavily in one sector or company can be risky. Many investors combine growth and value strategies to balance potential reward and risk, tailoring their approach to their goals and risk tolerance. To sum it all up, growth investing is about identifying companies with strong potential to expand their earnings and profits over time. It focuses on future opportunity rather than current price, often in innovative or emerging industries. It offers the potential for high returns, but comes with higher volatility and usually lower dividends. For investors, growth investing can be a powerful way to benefit from innovation and expansion, as long as they are patient, maintain a long-term perspective, and diversify to manage risk. Thanks for watching this video. Not sure where to go from here? You don't need another video, you need a plan. Grab the free 5-day series below and start investing with confidence. The link's right here on screen and in the description. Don't miss out.